Welcome back to another video. Today we've got an on-camera appearance, face reveal, whatever you want to call it. And today we're talking about Lifecycle funds. So Lifecycle funds, essentially they are going to be something, it's a mutual fund product that's going to be involved in pretty much any retirement program. Most people either have to deal with them, or you can only use a Lifecycle fund, or you have an option to use a Lifecycle fund. So it's important to know generally what they are. So I'm going to be using the government Lifecycle fund, or the Army or DoD Lifecycle fund as an example. However, these are generally the same types of things that you'll see in other Lifecycle funds. So this should be valuable whether you're in the military or not. So if you guys like this, make sure you guys give it a like, and let's get into this. The logical first place to start is why I'm doing this video. Why I'm doing this video is somebody asked me, should I be in the G fund? I'm in the G fund, should I stay there? And I'm not going to necessarily say no. However, I'm not in the G fund. I will say that. And that's not financial advice to get out of the G fund, but let's see what actually the G fund is and the types of returns you can expect from the G fund and why. So going into my computer here, we've got the G fund. So we'll start with these individual funds, and then we'll work our way up to see what the Lifecycle fund actually is. So the G fund, let's see what it is. Basically, it's government securities, right? So it is when the government issues debt because they need to pay for a program, let's say stimulus checks, or let's say foreign aid, or whatever they want to fund, they will issue a loan to the public. The public gives money back to the government, and the government pays interest on that loan. So the reason right now that the G fund is not so great, it could be good for some people, but it's not going to give you a very high return, is because they are pegging interest rates to be extremely low. So the way that bond prices work essentially is that when the interest rate is very low, you're not making very much money on that loan. So the only place from essentially zero that interest rates could go is back up. So when the interest rates go up, the price of the bond goes down because it's worth less, because you're making less money on that bond. So the next place that the G fund can go as far as price, not necessarily as far as interest rate, is most likely down, unless we go into negative interest rates. But a lot of people have expressed in the US that we should not and will not go into negative interest rate territory, but that is yet to be seen. So there is some risk involved with the G fund, and likely the next place that the price is going to go is down. Now, obviously, like I said, not a financial advisor, but if you look at the signs, G fund does not look that great right now. However, it does have a relatively stable price. So the price is relatively stable on that. So you're not going to get much return, but most likely you're not going to lose too much on the G fund. So because the government rolls over their debt in short-term debts, but that's a whole different topic for a whole different time. For the most part, short-term debts, you know you're going to get paid back for the most part, because the government will print the money. So the price of the debt does not actually change much, the price of the bond. So that is the G fund. C fund. C fund is the common stock index. So that's basically the S&P 500 index. So if we go in here into the C fund, we've got 1 year returns are 18.31%. So the C fund would have returned you 18.31% if you would have just invested into that in 2020. Year-to-date return says 1.01%. As of the beginning of this year, the returns haven't been so great. You could say that the stock market is overvalued right now, but that's a different topic for another day. Let's move into the F fund. So the F fund is the fixed income fund. So basically what that is it's the US bond index. So it's bond indexes that, let's just go in here and read what it says it is. So F fund investors are rewarded with the opportunity to make higher rates of return over the long term than they would from investments in short-term securities such as the G fund. The overall risk is relatively low in comparison to other fixed income investments in the market, because the F fund only includes investment grade securities. So you're basically investing into investment grade debt, right? So corporate debt. So the F fund mirrors the Barclays US Aggregate Bond Index, like I said earlier. So essentially when companies need that money, they go out to the marketplace and they borrow that money. So you're going to get a little bit of a higher return on this F fund than you would on the G fund. But they're basically G fund, F fund, they're both loans. So they're loans to the government, G fund, loans to corporations, F fund. So C-Fund is the common stock index, S&P 500 index. If you look at the 1-year returns, 2020 returns were 18.31%. So that's a pretty good return in comparison to your, let's go back to your G-Fund. Last year, the G-Fund returned 0.97%, and the 3-year return was 2%. F-Fund, 1-year return was 7.5%. So the bond fund went up. What we're starting to see in the markets, this is a little bit deeper of a insight, is that bonds and stocks are starting to be a little bit more correlated with one another. They're starting to both be a risk asset. So this is part of what they call the everything bubble. It's a result of the money printing that they're doing. But anyways, point being, the C fund is going to get you a much higher return than your F fund over a long period of time. Also, another thing to know is that the C fund, on any given year, it could crash by a lot. The G fund with your short-term bonds will crash a little bit less, so that's considered a little bit less risky, whereas your F fund is a little bit more risky than your G fund. C fund is generally more risky than that. S fund is what we'll go into next. So this is going to mirror the Russell 2000 index. Let me just read this off. The S fund investment objective is to match the performance of the Dow Jones U.S. Total Stock Market Index, a broad market index made up of stocks of small to medium U.S. companies not included in the S&P 500. So these are basically the small caps. So this one is going to be a little bit more volatile. When the economy goes bad, the S fund goes bad. So if you expect really bad economy, then the S fund is not a great place to be at the time. And if you expect a really good economy, as we see, last year the S fund returned 31.85%, and that's because when we thought that the businesses were going to go under, the government came in, they printed a bunch of money, and they saved those small businesses. So those S fund went way through the roof. So top 10 holdings in the S fund: Square, Uber, Zoom, Twilio, Snapchat, Blackstone. As you see, there's a bunch of those fast-growing tech companies. These ones are not included in the S&P 500, and these ones just went up. They just rocketed to the moon last year. So the one thing that you should know about the S fund is that these small cap, medium cap companies, if the stock market does crash or correct, these ones are going to take the beating the hardest. So last one, iFund. And then I'll give you guys the Lifecycle funds. We'll look at those, and I'll give you guys a little bit of my opinion on all of these things. So iFund is the International Stock Index Fund. So basically, it gives you exposure to companies that are non-US. So you're basically investing into the index that is non-US index. So last year, it returned 8.17%. This year, it's down on the year. So that's something to keep in mind there. Basically, this is just saying that you want to be exposed. If you want this fund, you're being exposed to the economy outside of the US. So we got Unilever, Toyota, some big names like Nestle, Roche Holdings. I'm not sure how to pronounce all these. I'm not going to lie to you. But I don't necessarily invest in this. However, if the international economy does better than the US economy, this fund will do better than the other funds. So that's the purpose of that fund. So let's go into the life cycle funds, then I'll give you my opinion on all of these things. So basically the purpose of a life cycle fund is to give you less exposure to less risk. So you'll be less risky as you get closer to retirement. So we've got this L2 2025, L2030, L2035, L2040. Essentially, the L fund is somebody who is retired. The L2065 is somebody who's going to retire in 44 years. So the easiest way to see the difference is to compare the funds based on somebody who is retired, and it'll basically tell us what they think about what they should be holding, and somebody who is going to retire in 45 years, because those are the opposite ends of the spectrum. So we look at this L fund. They've got us in a bunch of G funds. So G fund's a little bit less volatile because it's those short-term bonds. They've got us in the F fund. They've got us in only a few stocks. So they've got us in about 9, 10, about 20% stock, and about 76% bonds. So if somebody's going to retire, or they're retiring very soon, you're essentially just going to put them into all bonds. That's what their idea is. I don't personally think that that's what I would like to do, just because that's my own preference, and I'll tell you guys a little bit about that later. Let's go over to the opposite side of the spectrum here. the L2065. So the L2065 has you in about 50% C fund, and then S fund 15%, almost no G and F fund, right? So they have you in almost no bonds. So basically what they're saying is companies tend to outperform loans in the long run. That's essentially what they're saying. So it really depends on your time horizon. When do you plan to sell this stuff? Do you plan to sell this stuff? And what's your tolerance for risk? So this person who's not going to retire for 44 years, it's better for them to own companies than it is to own a bunch of loans. Let's go to L2040, see what they got here. So this is somebody who's going to retire in 19 years. So they've got them in 36% C fund, they've got them in 10% S fund, so that's about 46%, plus 5 here, that's 51, 71. So they got them about 71% stocks if they're going to retire in 20 years. So like I said before, I'm in 100% C fund because I think that the US economy is going to outperform all of these other things over the long term. Like I said, that is my opinion. That is not investment advice. However, what we generally see is that as you start to go towards your retirement date, they start to shift you from owning companies to owning loans to companies and loans to the government. So hopefully that clears some things up about what a life cycle fund is. And I promised you guys my opinion on these things. So I don't really plan to sell my investments in the same way that many people plan to sell their investments. I plan to live off the interest of my investments. So in other words, if I were to, let's say, have $10 million in loans to a company and they were paying me a 10% interest, that mean that they're paying me $1 million a year. I'm using 10% interest because that's an easy number. I would plan to spend that $1 million a year instead of selling off some of that $10 million that I own. So that's my plan. I don't really plan to necessarily sell things as most people's plan is in retirement. I don't plan to sell. I plan to live off the interest or live off the dividends or live off the rents from properties. So anyways, hopefully you guys learned something from this video, and I'll see you guys in the next video.